All right, let's imagine the entire US financial system is going in for its regular checkup. We're about to open up the doctor's report and see just how healthy or unhealthy it really is. So let's just get right to it. The one question that really matters, the one we're going to try and answer today, is how stable is the US financial system really? And who's the doctor in this scenario? Well, that would be the Federal Reserve. As the country's central bank, one of their biggest jobs is to be the watchdog, to look out for those big, system-wide risks. They're basically the cardiologist for the economy, constantly checking its pulse. Now, we're not just guessing here. We're going straight to the horse's mouth. We're diving into the Fed's November 2022 Financial Stability Report. Think of this as the economy's official medical chart, the real, hard data on what was going on at that time. Okay, so the Fed's checkup isn't just a quick look-see. It's super structured. They run 4 key tests to check for any weak spots. We're going to look at asset valuations. Are things just way too expensive? Then, borrowing risks. Is everyone in way over their heads with debt? After that, financial leverage. Are the big financial players gambling too much? And finally, funding stability. Is there a risk that money could just vanish overnight? We're going to break down each one. All right, let's get into it. Test number 1, asset prices. The big question here is simple. Are things just too expensive? You can think of this as the Fed taking the market's temperature, checking for a fever to see if prices have gone crazy and disconnected from reality. So when the Fed talks about asset valuation pressures, what are they really getting at? Basically, it's when the price tag on stuff like stocks or real estate gets way out of whack with the fundamentals. Things like company profits or how much you can get in rent. And that's a huge deal because if prices are floating up in the clouds, they can come crashing down really fast if everyone gets spooked. And on this point, the Fed was not subtle. Look at this quote directly from the report. They said that even while things were slowing down, real estate valuations remained very elevated. That is a major warning flare. They're telling us that one crucial part of the economy was still running way, way too hot. So the results for test 1 came back with a real split diagnosis. On one hand, for things like stocks and bonds, the fever had kind of broken. Prices had come back down to earth, closer to their historical averages. But real estate? That was a whole different ballgame. Home and commercial property prices were still way up there, super high compared to what people were earning or what places were renting for. And you know what fuels that kind of thing? Debt. Which conveniently brings us to our next test. Okay. On to test number 2, how risky is our debt? This is all about figuring out the weight of all the borrowing out there. The Fed is looking at the debt burden on pretty much everyone, from regular families to the biggest corporations. And why should we care about this? Well, think about it. Too much debt is like a pre-existing condition for the economy. It makes everything more fragile, so when a small shock comes along, like a minor downturn, people and companies loaded with debt have to cut their spending. And that's how a little problem can spiral into a huge recession. And just to give you a sense of this scale we're talking about, get a load of this number. By the middle of 2022, businesses, not banks, but regular companies, owed a whopping $19.5 trillion. That's a mind-boggling amount of debt. It's the kind of number that definitely gets your attention. But, and this is a big but, here's where it gets interesting. Even with that gigantic pile of debt, the report found that, for the most part, businesses were actually doing a great job paying their bills. Why? Because earnings were super strong. In fact, their ability to cover their interest payments was the best it had been in 2 decades. Even the riskier companies were holding up pretty well. And what about regular people, households? Well, the picture was pretty solid there too. Debt levels weren't crazy high compared to the overall economy, and most of it was held by folks with good credit. Plus, a lot of homeowners had a nice cushion of equity in their homes. But there was one big watch-out from the Fed. With interest rates and inflation on the rise, some families could really start to feel the pressure. All right, moving on to test number 3, leverage. So now we're not talking about regular households or businesses anymore. We're looking at the financial system itself. The question is, are the banks, the hedge funds, the folks actually doing all the lending, are they taking on too much risk? So, what exactly is leverage? In simple terms, it's just using borrowed money to make bigger bets. It's like putting your investment on steroids. And it's a classic double-edged sword, right? If your bet pays off, your profits are massive. But if it goes south, your losses are just as huge. And that's how you get financial firms failing and taking others down with them. And just like before, the diagnosis here is split right down the middle. You've got the big traditional banks, and they looked pretty sturdy. They had plenty of capital, their safety cushions were strong, and the Fed's stress tests showed they could survive a really bad recession. But then, you have the hedge funds. And for them, the report used the phrase, somewhat elevated leverage. That's Fed speak for, we're keeping an eye on this. And this is where things start getting a little spooky, because the Fed itself admits there are things they just can't see. The report straight up says that finding these hidden pockets of leverage in the less regulated corners of finance is really, really hard. So we don't have the full picture. And that uncertainty is a huge risk, especially when you think that this hidden borrowing could be what's propping up those super high real estate prices we talked about earlier. See how all it connects? Okay, that leads us right into our final test, number 4, which is all about funding risk. A simpler way to think about it is, where could the money just disappear from in a panic? This is all about the risk of a classic run on the system, where everybody rushes for the exit at the same time. Yeah, the classic bank run is the perfect example. The problem starts when a financial company borrows money short-term, like overnight, to fund something long-term, say a 30-year mortgage. It works fine until it doesn't. If all those short-term lenders get scared and demand their cash back at once, the company has to sell off assets at fire sale prices, and that's how a collapse starts. And the amount of money we're talking about here is just massive. We're looking at $19.1 trillion in what the Fed calls runnable money. That's money that could try to flee in a panic. And you can see how it breaks down here. A huge chunk is from uninsured bank deposits, with money market funds coming in second. That is just a staggering amount of cash that could get nervous in a crisis. The Fed's report really zooms in on a couple of specific weak spots here. First, prime money market funds. They can be shaky because they hold a lot of short-term corporate debt. If people suddenly worry that companies can't pay their bills, you get a mass exodus from those funds, which can spark a panic. And the second one they flagged? Stablecoins. Yeah, in the crypto world. They're supposed to be pegged to the dollar, but a run can prove they don't actually have the cash to back it up, and that kind of collapse could easily spill over into the traditional system. So, we've gone through all 4 tests. We've checked the temperature, looked at the debt, peeked at the leverage, and assessed the risk of a run. So, what's the final verdict? What did the Fed say were the biggest storm clouds on the horizon back then? Now, this is really fascinating. It shows just how quickly things can change. The Fed asks experts what they're most worried about, and look at the difference in just 6 months. Back in May of 22, the top worry, by a long shot, was the war in Ukraine. But by November, the number one risk had become persistent inflation and the Fed's own aggressive rate hikes to combat it. And look at market volatility. It came out of nowhere to become a huge concern, a massive shift in a very short time. And so that really leaves us with the big lingering question, doesn't it? The Fed's checkup showed a system that had some serious interconnected issues. We had real estate prices still way up in the stratosphere. We had the mystery of hidden leverage in the financial shadows. And we had trillions of dollars that could run for the door at a moment's notice. The system was holding together, sure, but the report basically leaves us asking, what's going to happen when the next big, unexpected shock actually hits?